Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
Welcome to the presentation. So, as I said, we're going to get into something that we call the money multiplier method here. And as we get through this, one thing I want to note to everybody here is ask questions. Ask questions live in the chat box. Use the Q&A box if you want. I do answer questions on the fly. I love the engagement. The more that we all participate, the more that we all are going to learn as we go through this presentation. So please, once again, use that chat box, use the Q&A box as we go through this. Now, also, I do tend to talk very fast when I get really excited about these kind of topics. I go pretty quick, so I'm gonna try to slow it down a bit for you all here, but just fair warning, I do tend to speak pretty quickly sometimes. All right, let's go ahead and get into it. All right, so now before we go into the main thing, I want to ask you a very simple, quick question here. What in life should you control? So once again, use that chat box. What are 3 things in life that you believe that we should control, or at least one thing in life that we want to control? Anybody want to take a guess as to at least what one of those things is? Most of us know what most of them are. One of them sometimes people don't get. Time and money, my money, exactly. So the first one that everybody goes to really quickly is money. I want to control money because when we think about money, we associate that with the things that money buys or that money creates. So we think money first. But there's also another one, and this one is, by the way, my most important one is for me, is time. Because time is that one thing that once it's gone, it doesn't come back. Money, by the way, and I've had to hit the reset button twice in my life, money comes back, but time doesn't come back, right? Time is very valuable. So how do you control time though? Well, you got to control money because money helps you control time. And so I've done this presentation from the middle of Idaho, by the way, where there's no internet, no cell phones, nothing, but I'm doing this presentation. I've done it while in my RV. I've done it in multiple different states, just having fun because I control my time. And I also control my money, but controlling time for me is the biggest one. But there's one thing that you have to control before these 2 things. And that thing is, as Anthony said, is your mindset. Because if you don't have the right money mindset, how can you control money? Because as we go through life, we are programmed to think a certain way about money, which is what we're going to be getting into in this presentation. So 1, mindset. We're going to talk about that here today. We're going to talk about how do you get back control of your money so that now you can control your time. Now, I want to share with you a quick quote by Will Rogers. And us at the Money Multiplier, we love this quote because it is so fitting. And it says, the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. And what that means is that we've been taught something about money, how money works, that most likely for most of us is not true. So once again, as we go through this presentation, go through this webinar, keep an open mind, and I'm going to challenge you. I'm going to challenge the way that you think around money, the way that you've been taught around money. So once again, keep that open mind. Now, I want you to take a picture of this scenario for an example. Let's say you have 100 18-year-old kids all gathered in a room or a big conference room, and you ask every single last one of them, these 18-year-olds, where are they going to be when they retire? What do you think they're going to say? Well, every last one of them is going to say they're going to be wildly successful. I'm going to be a millionaire, maybe even a billionaire, right? Think of inflation, right? They're all going to say that they want to be successful. But here's the deal. Fast forward to when they are retired. The fact of the matter is this, that only 5 out of those 100 kids are going to be financially secure by the time of retirement age. 5%. That's crazy when you think about where we live. America, even Canada's included here, by the way, but one of the richest countries in the world, and yet only 5 people at the age of retirement are going to be financially secure, by the way. By the way, it's not financially free, just secure. So let me ask you all a question. Give me a one in the chat box if you want to be one of those 5%. Do you want to be one of the 5 people that is financially secure or free in retirement? So once again, give me a one in that chat box. He says, yeah, probably my kid living off me. Yeah, exactly. Frank says one. Yeah. Sean says one. Melinda. Yes, exactly. We want to be one of those 5%, right? So how do we do that? Well, the method we're going to be talking about here today is one of the ways that you can really get to that level and really have that security. Okay. And by the way, that number that I talked about, that 5%, it actually comes from the Social Security Administration. And they literally stated that 5 out of 100 people will be financially secure at retirement age. Kind of scary, right? So we want to be one of those 5. Now, before we get into it, who am I? Some of you know who I am, some of you don't. So once again, my name is Brian Fouts. And I did follow that traditional path through life. And I'm not going to talk much about me, but just you guys have some context here. I got a degree from Washington State University, go Cougs, if you know that, who that is, in construction management and business. And I did that for like 14 years and I did not like it. Did not like it. But that was what I was taught to do. And I call that the hard way, not the traditional way, but it's the hard way. I was raised lower class. I remember getting up in the mornings, putting wood in the fire to get the house warmed up, but that was just what I thought was normal. And I was told to go to school, try to get good grades. I tried, go to college, get a degree and get a job. I did all of that. That's what I was told to do. And even then, save into a 401k. I had the house with a mortgage. I had the growing family with car loans, student loans, credit card debts, all of this stuff. But that's what I was told. Yet people said, "Oh, you're living the American dream," and it felt like the American nightmare to me. Honestly, it did because I was like, "Man, this is not cool. I don't feel like I'm where I should be." And it kind of came to well, I guess this is what planted the seed for me. I was in a doctor's office, and they had the coffee tables with all the magazines on them. Remember that? Now it seems like they don't have those very much anymore because we all have cell phones. But there was this financial magazine, and I remember I opened it up to this article. It was talking about, it was a financial magazine, and it said that the average millionaire or millionaire knows their net worth. They know their net worth. And I realized I didn't know mine. So I said, I'm going to go find out what mine is. I was worth a negative amount of money. After over 10 years working my butt off in this career, I was worth a negative amount of money. Made no sense to me. How is this building wealth? How is this going to help me later on down the road? And I did the math, and I'd be worth less and less every year. So I said, hey, I got to do something different because I was like, what the blip is going on? And then something happened, and I'll share a quick little story here, really quick. My grandfather was my idol, and he was a local high school coach, and everybody idolized my grandfather because he was known in the community because of who he was and just a solid guy, and I loved him. And he was working really hard in that career, but he was so excited to retire and travel around the West Coast with my grandmother, his wife, and go to sporting events, that kind of stuff in a motorhome. And he did that. He retired right before I went to high school, and he retired and started doing that with my grandmother, but it was very short-lived. He got really sick after a couple of years, got Parkinson's, got leukemia and some other things, had to go on dialysis, and eventually he passed away. Never really living that retirement life that he had dreamed of. And that really had a massive impact on me and said, hey, do something different. So that's what I did. So I left that career, got into entrepreneurship, got into business, ended up, years later, starting up a financial education business with like Robert Kiyosaki's advisors. So his personal advisors were my partners on some of that businesses. And in 2021, that business did over $2 million because anybody can say anything on the internet, but I just want you to kind of showcase some of the things that I've done because of what I've learned, because I changed my mindset and I changed what I was focusing on, and I changed what I believed in when it came to money and business and entrepreneurship. I was able to do some pretty amazing things. And this is one of the business. Actually, it was an Inc. 5000 business, I think in 2021. But that has allowed me to control my time. And so this is just me and my family and some other things that I've done. If you guys can't tell, I love cars. So I'm into cars, that kind of stuff. That's my parents' property up in Alaska. They're up there right now. But I traveled. I love to travel. I love to have experiences. That's my big thing. And along this, I came across infinite banking, what we're going to be talking about here today. And that was something I fell in love with, and it's had a massive impact in my own personal life to the point where I speak at events on this topic. I have taught thousands of people how to do this concept, help them use it in their lives. And I'm doing that here today for all of you. And I just love doing this. Love the fact that I can share this with you all. So who else is talking about this thing? So I want you to understand one thing. Like, this is not a new concept. This is something that has been talked about for well over 100 years, been known for, a lot of people, but it's actually talked about in a lot of known books. So Second Chance, that's Robert Kiyosaki wrote that book, by the way. I have my copy right here. I actually found it here this morning. It's a great book. He talks about this concept inside that one. Money Master the Game. Actually, I have that book as well. It's a great one. It talks about this concept inside that one. And then, of course, the kind of not the Bible of this concept, but the foundation of it is called Becoming Your Own Banker. Unlock the Infinite Banking Concept by R. Nelson Nash. I have my copy right here as well. And so I recommend you read these books if you guys want to. They do talk about this concept. Additionally, a couple other books is Mapping Out the Millionaire Mystery. That's by Brent Kessler and Chris Naugle. They're obviously Chris is whom I work with, and Brent, and all of us here, and I've learned a lot from him. And then the Private Money Guide, also by Chris Naugle, is also a great one. Now, if you want those books, by the way, the bottom two, the Mapping Out the Millionaire Mystery and the Private Money Guide, I have them on PDF. I'll put my email in here just right now, and then I'll put it at the end as well. If you guys want to email me, I'll send you a link to the digital copies of those bottom two books. I think it's 2 or 3 of them, so you guys can grab those ones. I definitely recommend it. They do talk about this concept quite a bit. All right, so that being said, let's talk about who has used this concept, this strategy throughout history. So who else has used this? So this was Jim Harbaugh. If you don't know who Jim Harbaugh is, he was a coach, and his multi-million-dollar salary and bonuses was actually paid to him through the infinite banking concept by the college. They used it to pay him. This guy, I forget his name, Joe Biden. That's right. He probably doesn't remember his own name, by the way. But when he became president, he had to disclose that he had 4 of these policies. Yep. At Disneyland. So Walt Disney was trying to start Disneyland, but he couldn't get a bank to lend him anything, right? And so he eventually used this concept, borrowed money from this concept, this policy to start Disneyland. So without this concept, we might not have Disneyland as we know it today. Kevin asked a great question. Is Pamela Yellen books based on this concept? Yes, they are. Her focus is a bit different, by the way, than how we focus on it. Hers is more like retirement strategy planning. We're more about wealth building, so it's a little bit different, but yes, they are to a degree. Yep. All right, McDonald's. So Ray Kroc, when he partnered with the McDonald's brothers to expand and grow McDonald's, he used infinite banking to fund the business and pay salaries, things like that for the first like about 7 or 8 years until it could be self-sufficient. And so without this concept, we might not have McDonald's as we know it today. The Pampered Chef, she used $3,000 borrowed from this concept to start the Pampered Chef. And of course, Warren Buffett, I think he acquired it for $1.5 billion. That's a pretty good return on your investment right there. And then, of course, wealthy families have been using this thing for over 200 years. The JPs, the Morgans, the Chases, the Rockefellers, especially the Vanderbilts, to a point, they kind of actually messed it up a little bit, but now you as well. Now, before we get into what this really is in the background, I want you to understand what this can do for you. What can it do with this in place? So 1, it creates guaranteed generational wealth, tax-free, by the way, day one. Day one, not year 30, not year 5, but day 1, guaranteed tax-free generational wealth. It also allows your money to grow uninterrupted, compounded for the rest of your life with guarantees. Guaranteed. I love that word guaranteed, by the way. Also, one of the 8th wonders of the world is uninterrupted compound interest or return. This does that for you. It takes control of your money away from the big banks, away from Wall Street, away from those big financial institutions that want to, in my opinion, steal your money as much as possible. And it puts the control into your hands. Remember, I talked about control at the beginning. Control of money. If the big banks have your money, Wall Street has it, 401k has it, they have control. This takes the control back and puts it into your hands. It protects your money from lawsuits, from bankruptcy, divorce, court orders, creditors in most states, by the way. And then it allows you to be the bank for things that you may normally use a bank for. So think of things such as real estate investing or buying a home, paying for college for yourself or kids, cars, homes, investments, retirement, all of those things, while still having all of the benefits listed above. What I mean by that is that a lot of strategies or opportunities will give you 1 or 2 things, right? But this does all of these things at the exact same time. So give me a 1 in the chat box if you'd like to have all of these things in place in your life to help you build wealth. Would that be good? Would you guys want to have these things in your life? Anybody want to put a 1 in that chat box if you guys want to have these things? I want to make sure you guys are all paying attention. There you go, Dana. There's Melinda, Kevin, Mary. Awesome. Okay, cool. Lee, absolutely. When you start, because here's the thing. When you look at, let's just say a 401k, it has 1 benefit. Hopefully it goes up. hopefully, right? In the next few years, that might not be the case. But with something like this, it's all of these things. So I call it stacked benefits. Yeah, Dana. Yeah, it's new for sure. For a lot of people, this is kind of eye-opening. These are what I call stacked benefits. One of these things might be good, but all of them combined is great. It is very powerful. Okay, so let's keep this stuff in mind. Now, as I said, as we go through the presentation, feel free to go ahead and take notes or if you want, but use that chat box, put in questions, use the Q&A if you want as well to ask questions. I will answer those on the fly, as I said before. Now, I want to ask you all a question here. So who learns quickly? Okay, kids, right? Kids. Yeah, exactly, Dana. Yeah, stacking is a good method of control. It is for sure. So kids learn quickly. And so you probably learned how to ride a bicycle when you were little. And if you haven't ridden a bicycle for a while, you can hop on a bicycle and typically ride it pretty well. It doesn't take long if you've forgotten, right? You can ride that bicycle. You hop on, you pedal, it goes forward, turn the handlebars to the left, it goes left. Now, what would happen though if the bike it didn't work that way? What happened if you hopped on the bicycle and you turned the handlebars to the left and the tire went to the right? That's called the backwards bicycle. Now you can Google that term after this presentation, by the way, not during it, but there's a video out there called the backwards bicycle. And that's what happens. When you hop on, you turn the handlebars to the right, the bike goes to the left. And in the video, the guy tries to hop on it and he can't ride that thing to save his life. He's just falling over, can't get it to work, etc. But then after practice, what happens? Eventually, his body and his mind learns how to ride the backwards bicycle. And so he can ride that thing. It's really kind of strange to watch. But yet, guess what happens when that same guy tries to hop on a regular bicycle after learning how to ride the backwards one? He can't ride the regular bicycle anymore. He can't because he's learned a different way to ride a bicycle. That analogy is the same with money. We are taught a certain way to think about money that most likely is wrong, right? It allows other people to take our wealth away from us. And you're going to see what I mean by that. And so learning how money really works is like learning how to ride the backwards bicycle. And once you learn how money really works, I'll be honest, it's for most people, it's very hard to go back to the old way of thinking around money. So as I said, keep an open mind. And one of the very most important things we're going to talk about with this concept is where your money goes first. Okay. All right. Now let's talk about why more people aren't successful. I'm going to go through this one pretty quick. So what are the mysteries of money? Why aren't more people successful? Well, what are the wealth killers? Well, most of us know what some of these are, but what are they? One is taxes. I love paying taxes, but guess what I love even more? Paying a lot less, right? I don't really love paying taxes. I don't mind, but I love to pay a lot less. So taxes is one of the things that once you control your money, you can control taxes to a degree. Inflation. Inflation is the silent wealth killer. And by the way, not to get into the weeds too much, but if y'all want to have a talk about this on a private call, what's the true cause of inflation? It is not rising prices. Rising prices is the result. Inflation is the inflating of the money supply, which is printing money by the Federal Reserve and fractional reserve banking by the banking system. That's what is inflation, by the way, and it results in rising prices, which takes about 2 to 3 years to feel the effects. Where are we at right now? Volatility. Think of the markets, think of the economy, think of things even like real estate to a degree. That volatility can really impact your ability to get a good solid return. Interest. Interest is one of the biggest ones out there because I think it was before COVID hit, the average family household was paying around $18,000 or $19,000 a year in interest. That's a lot. Then, of course, mindset. Following the status quo. Fear, FOMO, fear of missing out causes you to, not be successful or to lose money oftentimes. Life in general, okay? And then what we are taught. So what we're taught is one of the bigger ones. That's why keeping an open mind is so important. Now, what's the definition of money? So by the way, it is just a means of exchange. That's all money is. It could be seashells, it can be gold, it can be silver, it can be even a dollar bill, although that does not have any true value behind it, just the government's promise. But that's just a means of exchange. Now, think of this question. What company uses compound interest? Do banks use compound interest? Most people think they do, but no, they charge you interest, but they don't use it themselves. Because if you wrote your name on, let's say a $100 bill and gave it to the bank, the teller, they don't put that in a box with your name on it. That bill goes into motion. They put it into motion so they make money off of your money. Now, there isn't a business in the world that uses compound interest as we talk about it. Are your dollars worth more today or in the future? Okay, so think of a dollar bill. How much candy or candy bars with a dollar bill buy you 20 years ago versus today? It's not the same right now, right? It would have bought you a lot more down the road than it does today. This is a funny question. Will taxes go up or down? Well, in most situations, it's going to go up. Unfortunately, it's going to go up, and so we don't control taxes either. The IRS does. And so when you think about taxes going up or down, think of this question right here. Would you rather pay taxes on the seed, planting a seed in the ground, or on the harvest after it's grown and you harvest it? When do you want to pay taxes? Anybody want to put that into the chat box? Is it on the seed or on the harvest? Anybody want to put that in the chat box? Well, I like that one, Anthony. Never. Great answer right there. Yep. Mary said the seed. Yeah, Anthony said the seed. Exactly. Yeah, we want to pay it on the seed, not the harvest. Okay, because when you do it on the harvest, once again, we don't know what the interest is going to be down the road. It might be more, and we don't control it. So we want to pay it on the seed. Okay, and think of it this way: when you look at like bread or milk, would you buy bread or milk and put it in the freezer for 5 years? Open the freezer up, and maybe the bread is now, instead of being 1 loaf, it's 2 loaves, or maybe instead of 1 gallon of milk, it's 2 gallons of milk, but it's been in there for 5 years. It's stale and not that great. Would you rather eat it 5 years down the road or eat it today? Okay. And what I mean by that is that we do things with money that we would not do with things that money buys. Okay. Now, what did I just say? We do things with money that we would not do with the things that money buys for us. So think of this. When you go buy a car, that's something that money buys for us, right? Would you go and buy a car and then put it in the garage for 10 years and then go drive it? Of course you wouldn't. But we do that with our money. We take our money and we put it over here, and then we wait to use it down the road. Okay. And so that's called, using it down the road, but we want to use it today and down the road. That's the different mindset shift right there. Okay. And then last question here is, what do you know about your retirement account? Okay. So what do you know about like a 401k, that kind of stuff? So here's the thing. A 401k is like what I just talked about. You put your money into that so that you can use weaker dollars down the road. You're putting strong dollars into a 401k today, but you're going to use weaker dollars down the road. So the concept here is, I want you to use your good dollars today, and then I want you to pay back with weaker dollars in the future. Like, that's a huge shift right there. So we've always been trained our whole lives to save our dollars now and use weaker dollars down the road. But I would rather use strong dollars today, right? And then pay back with weaker dollars in the future. That is one of the best ways to build wealth, okay? And then with a 401k, retirement accounts, who controls the money? Remember control of money, what I talked about at the beginning? With those kinds of things, you don't control your money. The IRS, the bank, Wall Street, your IRA or 401k custodian controls that. So you can actually even lose money. That's risk, right? So when we use the word investment involve one thing, it's risk, okay? We want to remove risk and gain back control. Okay. Now, I know that what I just threw at you was quite a bit of stuff in these last 2 slides, but the whole purpose is to get you thinking differently around money, okay? Because I don't want you to accept the traditional way of thinking about money. We want to get rid of those old concepts and introduce new ones and start really changing the way that we think. So now let's kind of get into how our money flows. This is really starting to understand how this concept works. So let's say you're going to go buy a car. Okay. And let's say it's going to be a $25,000 car. Maybe it's, it doesn't matter if it's a $25,000 car, $100,000 car, or $5,000, it doesn't matter. Now, let's say that you have been saving up money into a bank. So you've been saving and saving money into a bank, you have cash, and let's say that bank is being very nice, by the way, and they're paying you 4% on your money that's in that bank. Now you want to go buy the car. So what do? You go to the bank and say, Mr. Banker, I want to withdraw my $25,000 so I can go buy this car with cash. And the banker says, hey, hold on a second here, man. Hold on. What if instead of you doing that, you keep your money in the bank, earning 4%, and I give you a loan against that cash in the bank, that's your collateral. I'm going to give you a loan of $25,000, and I'm going to do it at 6% over 60 months. So you don't lose the cash inside inside your account, but you have a loan now, okay? So would this make sense? Would it make sense to have $25,000 earning 4% and a loan of $25,000 at 6% that you're paying back over 5 years, okay? What's the math? So Anthony says yes, okay? So here's the thing, math is math. Let's go look at the math on this. Your monthly payment on the car is going to be $483 per month. Now, someone might say, well, Brian, if I had paid cash, I wouldn't have that monthly payment. Like that's what I'm going to stop here for a second because I get that question or that statement all the time. Brian, I can just pay cash and not have a payment. Well, let me ask you a question. How'd you save up the $25,000 in the first place? By saving a certain amount of money per month or out of every paycheck to save that cash up. So if you spend $25,000 in cash, are you going to stop saving money back into that account? Of course not. You're going to do the same thing. So this is the same cash flow situation. Okay. Now, the future value of those payments is going to be $28,999. Just for the sake of math, I'm going to round up $1 and make it $29,000. Now, what's the money inside of the bank doing that's earning 4%? The future value of that money is $30,525, meaning that you actually made $1,526. Okay, so you made money by earning 4% while paying 6%. Now, why is that? Why is that? It's simple math. So the bank is going to be earning compound interest on that $25,000, meaning you're earning 4% on a larger balance every month, every year. The car loan, you're paying 6% on $25,000, but you're paying 6% on a decreasing or smaller balance every month, every year. So the effective rate is going to be reduced every single payment. So that's how this works. You can earn money earning 4%, or sorry, you can make money earning 4% while paying 6%. Once again, it's just math. Change the way you think about money. Okay. Now, what is the money multiplier method? Okay. The machine, first off, we're going to talk about the machine. Second off, we're going to talk about the marathon. It's not a sprint, it is a marathon. And then we're going to talk about the millionaire, right? Everybody's favorite topic. Okay. Now, Anthony, yes, if you had the 25K, correct. Now, when you want to build wealth, you do have to have some discipline. And we're going to talk about what that looks like, but you do have to have some discipline, right? We can't create something out of nothing in most cases, unless you're doing some certain types of real estate. Yep. And then Dana, we're going to get, I hope I pronounced that correctly, but we're going to get into more examples too. Now, let's talk about the machine. What is the machine that we're talking about with infinite banking? So it is nothing more than a dividend paying permanent whole life insurance policy from a mutual insurance company, specially designed. Yeah, Anthony, IRS. Yep. Yeah, there you go. Yeah, so that is the machine. Now, what I want you to understand is, once again, I want you to picture a car. Picture a car. The car is the infinite banking concept. That's your bank. That car has wheels. It has brakes. It has gas tank. It has windshield wipers and seats and a radio. Now, what makes that car, the infinite banking concept, go down the road? An engine. Without an engine, it can't function, right? All these other benefits can't work unless you have the engine. Make sense? So with infinite banking, the engine is a dividend paying, specially designed whole life insurance policy from a mutual insurance company. Okay. So I don't want you to get hung up on the product, which is the life insurance policy. It is just the engine that allows the infinite banking concept, or the car, to function and have all of these other benefits that are outside of the policy. That makes sense? Okay. And also, if you're thinking, well, this is life insurance, I don't like, what do you mean life insurance? I don't really like that. It's like, oh my gosh. Well, when I first heard about this, I thought, oh, life insurance, I don't need that. But then when I realized what all the other benefits, remember that slide I talked about before? Uninterrupted compound interest, privacy, protection, guarantees. Then I realized, oh, okay, it's all of these other things as well that make this make sense. Okay. Now, who do you think buys life insurance? BOLI, bank-owned life insurance. This is incredible. So banks are the #1 purchasers of whole life insurance, and in the world, by the way. They own billions upon billions upon billions of dollars of life insurance on their CEOs, executive, bank presidents, bank managers, right? It is crazy how much they own. In fact, they own more life insurance than they do buildings and real estate combined. And since 2016, they have quadrupled their insurance holdings. Now, why is that? Why would banks take your money, by the way, and put it into these kinds of vehicles? Do they know something that maybe we don't know? Perhaps. But what we're talking about doing is doing one of the same things banks are doing with our own money, by the way. So yeah, Anthony said, yeah, whole life engine plus PUA Nitro, good machine. Exactly. Yep. Okay, so now, how does your money flow? Now, this is something that we talked about, before originally, right? We showed you that you can make money earning 4% while paying 6%. Okay. So we showed that math right there. So the question is okay, if that is how banks make money, on this example, by the way, how we're making money is because we can be the bank on both sides now. So what if instead of just being on the consumer side, which is you're buying the car with a note, you're also the bank as well? What if in this situation, with the bank loaning you money and you buying a car, you're the owner on both sides of the transaction? You're the bank and the borrower. That's pretty cool. So that is part of what we're talking about. But one thing I want you to understand is, how do banks make money? Now, this when I grasped this concept, it kind of was like, oh my gosh, it's kind of gross how banks make money. So let's kind of talk about this for a second. So let's just say that you deposit $100,000 at a bank, and let's just assume that bank's going to be very nice and they're going to pay you 4%. Now, when you think of a balance sheet is assets versus liabilities. Okay, assets provide value, liabilities take away value. Okay, so think of it that way. When you deposit money with a bank, is that a liability or an asset for the bank? Okay, it's a liability. Yep, Anthony said liability. It is a liability to the bank because they owe you $4,000. Okay, but a bank does not just sit on your money like a chicken on an egg, right? They're going to go put that money to work. That's what they do. So let's say they lend it back out at 7% on a 30-year amortized mortgage on a home. Okay, what does the seller do? Well, the seller does not just take that money and just sit on it. They put it right back into typically a bank. What's the bank do? Once again, they don't sit on that money. They put it to work. They lend it out maybe via a car loan, maybe at 8%. What's the car dealership do? Well, right back into the bank again. Okay. What's the bank do? Goes right back out again. Maybe it's on a HELOC, maybe home remodel, maybe at 9%, something like that. What does the contractor do? What do the employees for the contractor do? They put that money right back into the bank again. What's the bank do? Same thing again. Maybe it's 12% on a debt consolidation loan. What's the credit card company do? Once again, right back into the bank. And by the way, this is not even talking about fractional reserve banking, which is a whole nother topic that I do all presentations on as well. But this is how banks handle your money. It flows in and out, in and out. It's always in motion, making them money to the point where they make 500% more off of your money than they're paying you. They're making like 20% or more off of your money than they're paying you. Okay. All right. So Frank had a question. Why do we have to bail out banks if they are covered with insurance? Well, that's a great question. The insurance they have is for a different reason. It's for liquidity, by the way. It's also for the fact that when they have insurance on somebody else, who's the beneficiary? It's the bank, by the way. So that's one of the ways they make money off of your money. But when a bank does fractional reserve lending and gets into problems where they are lending in ways that are nefarious or they shouldn't, then they get upside down, and there's just no way they can come out of that. And so it's a separate thing. But yeah, I mean, they have it because they have to have liquid assets, but they don't want it to be doing nothing for them. So life insurance, by the way, is considered a liquid asset, and it grows uninterrupted. So they're making money that way as well. And by the way, when they do get bailed out, that does come into play, the cash value. Yeah. Then Anthony said, yeah, like having grease in a pot, needs something to be do. Yep, exactly. You got to do something with it. Now, here's something you can do. So if you're saying 500%, that's crazy. Well, look at it this way. You can go to Bauer Financial and just look it up if you want. So it's BauerFinancial.com, and you can look at any point in history and see how much banks have made off of your money. Anywhere from 400 to 1,300%. Like it's just crazy. Now, someone says, well, if they're making that much money off of your money, how do they get bailed out? It's because banks have the ability to do some very nefarious things that make no sense. Like if you look at it from the outside, like you're saying, why would you ever do that with money? Well, they do it. And then of course, sometimes things happen, like the economy changes and they lose because they do things with money that we would never do, which is kind of funny that you put your money with them and then they go do something that they should never do with your money. Yeah, so there's a whole topic on that we can get into on a different presentation. All right, so now that you understand what banks do with your money, let's kind of think about our annual pattern of spending. Now, this is something that a lot of people just don't understand that they're doing with their money because we are taught to do this. And once you start to realize what's going on, as I said, it's very hard to go back. So let's look at where our money goes. How do we spend our money? So let's assume that $1 comes into our hands or our bank account from our paycheck or business or whatever it is. Where does it go? Well, 20 cents of every dollar goes to automobiles. Okay. 30 cents of every dollar goes to housing, rent, mortgage, etc. 40 cents of every dollar goes to everything else. Think of travel, entertainment, food, clothing, all that kind of stuff, right? And then 10% goes to savings. Now, what I want you to understand here is 90 cents of every dollar goes to somebody else first. And then whatever's left over goes to savings, 10%, by the way. And I don't think it's 10%. I think it's less than that. I think it's less. I think before COVID, I think it was almost a negative amount. And then in COVID, it went up quite a bit, by the way. And then now it's come drastically down. I think it's a negative number again right now. It's unfortunate. So yeah, so savings is usually the last thing. And by the way, if you go talk to your financial planner, what do they talk about? And by the way, I was talking to a financial planner right before this call who was doing an infinite banking policy with me because his thinking has completely changed, by the way. But most financial advisors will talk to you about your savings, okay? Not what you're spending, what you're saving. And they'll say, hey, let's take that savings and let's put it into riskier categories to make more money while you're young, and then et cetera, et cetera, et cetera. I don't really want to talk about your savings per se. I want to see, how do we make it bigger, okay? How do we make that bigger? So same scenario. So as I said, 20 cents of every dollar that you earn goes to your car. Okay, that's things like, gas and stuff. Now, 5 cents of that 20 cents is interest. Let's put that interest back into our savings. Okay. Now, housing is very different. So as I said, 30 cents of every dollar goes to housing, but how much of that 30 cents is interest? Well, let's look at an amortized 30-year mortgage, which, by the way, the mortgage company's created to essentially take your money. In the first, call it 7 years, 75 to 80% of every dollar that goes to that mortgage goes to interest. 25 cents. That's crazy. It's insane. So take that 25 cents and put it back into savings. Jumps it up by quite a bit, right? Then let's look at everything else. Now, everything else, around 5% goes to interest. Let's put that back in the savings. So now what have you done? Well, you have drastically changed the way that your money is flowing and how much of it you control, because now you control a larger portion of it, the interest. If you were able to do that, would that build wealth for you? Would that create more money for you? Yeah, of course it would, right? So that's what we're going to be talking about, is how do you start to gain back control of that money and of that interest? Okay. And yeah, Anthony, yeah, a good rule of budget for 3 categories is 50% of pay goes to needs, then wants, and then savings. Yeah, it's a good rule too as well. But yeah, so you have to have the rule first off, and you have to follow it. That's the biggest challenge for a lot of people, because we're just not taught that kind of stuff. And there's a couple of concepts that I won't get into here on this presentation, but there's one concept where the more you make, the more you spend. And it's a natural thing that if you don't think about what you're doing with the money you're making, when you make more money, all of a sudden your needs go up. And things that things that are like wants, like a nice car that you don't need but you want it, eventually wants become needs. And it's they call it the creep factor, and that definitely can erode wealth for sure. So what I want to show you right now is how to get all the money back for every car you'll ever buy, drive, and own. And this is a great example. As I said, I love cars. I don't have a 67 Mustang like that one right there, but I do have a 67 Mercury Cougar that I restored. I love cars. But yeah, this is a great concept as to how you can gain back the money from every car you'll ever buy, drive, and own. So before I get into that example, I'm going to go through this. I want to explain a few things. On the right-hand side is what we call, it's a simplified policy illustration that shows the policy. This on the left-hand side, it shows year, it shows age, it shows money going in, and then it shows when you have this policy, when you put money into it, into infinite banking, into a specially designed whole life policy, you have something called cash value that builds up that you can borrow against. So you're going to see that in action right now. Now, when it comes to the premiums, when you think of premiums with something like life insurance, I don't want you to think of it like an expense, like home insurance or car insurance. That's an expense you got to pay. With these, we're going to call them deposits or premium deposits, because when you deposit into your policy, you get value. You can borrow money back out again. Okay. Age. So we're talking about people saying, oh, you're talking about life insurance. Oh, I'm 50 years old. I'm 60 years old. I can't do this. Yes, you can. Okay. Because we're not focusing on the death benefit, which I'm going to talk about here in a moment. So age doesn't matter in most cases. You could also do these on other people. We'll talk about that a little bit later on. There is a death benefit. Now, we do not focus on the death benefit per se, because that's what traditionally when you hear life insurance, we think of, oh, it's just death benefit. No, we want to focus on what we call the living benefits, not death, but living benefits. Yes, the death benefit is a nice bonus. It's guaranteed. It's tax-free. Generational wealth right there. Pretty nice. And it's going to be a multiple of what you put in. But once again, we want to focus on the living benefits. Okay. All right. So let's look at the machine. So we're going to do a policy. Okay. This policy is going to have a premium of $10,000 per year. Now, I'm just using an arbitrary number, 10,000 per year. It can be 5, it could be 20, it could be 100, it could be, it could be $8,000. It's whatever is best for you, and we work with you on those numbers, by the way. But let's just look at a deposit of $10,000 per year, okay? Now, as you put that money in, you're going to have cash value growing inside that account. Now, I'm going to be very ultra conservative with these numbers. They grow a lot better than what I'm showing here, but I want to be conservative, right? So that when you guys see a real policy, you'll see like, holy cow, the numbers are actually a lot better than what I'm even showing here. But let's assume these numbers right here. Now, as the cash value grows, that's what you can borrow against. So let's say in year 3, you take out $25,000 cash, it's cash in hand, out of your policy. You loan it to yourself, okay? Now, you're going to be a good banker. We call this being a responsible banker to yourself. You're going to pay the policy back, the insurance company back with interest, okay? So you're going to pay that back. What's that look like? So you put in $70,000 in premiums into the policy. You also put in $30,000 via the loan payback, okay? So that's $100,000 you put into this policy. But what else did you do? Okay, well, you took out $25,000 of cash. You had cash in hand. By the way, I'm using a car as an example. You could go pay off debts, which we show you how to do that. We're going to do an example of that here in a moment. You could go buy real estate, the cash flows, which would completely change the scenario here. You could do college education, whatever it is you want, but I'm going to use a car, okay? So you've put $75,000 into the policy, essentially. Make sense? 100,000 less 25. Now, you have recaptured 91 cents of every dollar so far that you put into this so far, okay? So you've recaptured a lot of that money so far. That's the ratio of $75,000 versus the cash value in the policy, by the way. Now, let's look at years 8 through 12, okay? In years 8 through 12, we're going to assume that you don't put any more premiums into the policy, no more deposits, okay? You can do that, by the way. So these are decreasing, not increasing. So you decrease it, you go to 0, but yet you do the same thing. You buy another car in year 8, okay? So you'll see the cash value is still growing. Keep that in mind. The cash value is growing even though you're not putting anything into the policy. It is still growing. And you'll see why here in a little bit. Now, same thing, you pay back the loan at 6%. Okay? Okay. What's the numbers look like? Okay, in years 8 through 12, you've put in $30,000 into this policy. Okay. But once again, you also took out $25,000 of cash. So essentially, you have put in $5,000. But here's the thing. You put in $5,000 into this policy in years 8 through 12, yet you bought a car for $25,000, and the cash value in your policy grew by $23,000, and you only put in $5,000. So let me ask you a question. So in this scenario, you've bought 2 cars for $25,000. You own them outright. You have $91,000 of cash value that you can use for whatever you want in this policy. And how much have you put in? You've put in $80,000, by the way. Right, 75 plus 5, yeah, $80,000. So let me ask you a question once again. Your $80,000 you put in, you actually earned money on that, and you own 2 cars outright. Would you guys like to have that kind of return on your money? Would you like to put in $5,000 and get $20,000 to $30,000 of growth? Would you like to own 2 cars outright and have actually increased your wealth by 10% in that same time period? Now, this is the conservative example. And give me one of the chat boxes you guys want. Does that sound like something that would make sense? Would that be a, so by the way, if you just paid cash, you'd pay $50,000, have the cars, and have nothing else. In this example, you have $91,000 and you own the cars outright. Yes, there you go. Mary said yes. Mary, Social Security monthly, potentially yes, potentially. It gets challenging because obviously you have to put cash into the vehicle to make it work. So it depends on your situation. We can always have a call and go through that for you. Okay, so that's one example. So in this example, the next one, so Jerry, how do those numbers break down? Which numbers, by the way? So the way that this one looks is that in this example, you've put in $80,000 into this vehicle. You have $91,000 and change of cash value that you can use for whatever you want. and you own 2 cars outright. Yeah, and Mary, there'll be a link here in a little bit where you can do that. But yeah, so Jerry, so that's the math there. And by the way, this is a very conservative example. But yeah, so the longer this is in play, the more you're going to have. Well, Anthony, but you got to remind yourself that you took out what out of the policy? You took out $50,000 of cash. You took out $50,000 of cash. That's cash in hand. Like you could have used that cash for anything. But so in reality, you put in a certain amount, you took out 50. If you put in 130, took out 50. Yeah. Not saying number is working. So that's the math on it right there. So if you look at the cash flow in your hands, not saying number is working. Not sure what that means, but and then percent of 0. Okay, I'm not sure what that means either. Oh, it's good math. Yeah, okay, yeah. No, the math is phenomenal. I mean, and by the way, this once again being conservative, when we run real numbers illustrations, it's better than this by far. It's better, but once again, sometimes the big numbers is hard to comprehend. But yeah, this is a great example of making money while doing traditional things like buying cars. All right, so let's kind of get to the next section here. So there's 3 rules we talk about with infinite banking that are very powerful. So one is pay yourself first. Pay yourself first. Why do we say that? We have been trained to pay your bills first, then take whatever's left over and put that in the savings. But that's the wrong way of thinking about this. So pay yourself first. The next thing is pay yourself with interest. Okay, pay yourself with interest as often as possible. By the way, not just in infinite banking, but in other areas, you pay yourself with interest. Because we pay banks with interest, we pay loans with interest, yet we don't pay ourselves with interest. It's very, very strange when we borrow from ourselves. And then last, recycle and recapture your money. What that means is that instead of just having your money going out to debts and not coming back, you want to recapture it and recycle it through infinite banking and keep it moving, keep it moving, keep it moving. And so we use that term recycle and recapture it quite a bit, because when you look at that example of the car, what we did is we captured the money first and then recycled it back through the policy over and over again to the point where we're actually building wealth, and we have cars that we own 100% free and clear, but our net worth went up by quite a bit. So if this works for cars, what else does it work for? Obviously, investing for real estate is amazing, but one of the more common things that a lot of our clients use this for is going to be for debts, because debt is for most people is one of the biggest killers of wealth. So I'm going to go through an example here pretty quickly of this is a doctor. I think this was a chiropractor, a rough example of what this looks like. So this was a 45-year-old male, had $478,000 of debts. Total payments back to that debt was $5,777 per month, or almost $70,000 per year. Now, if this doctor paid all these debts back, traditionally, that would take around 19 years to pay it all back. That's pretty staggering. So I'm going to show you a completely different way to flow this. Now, one thing I want to be very clear on is that this doctor has money that he can put towards a policy premium. Okay. So in this example, we're going to show this. Okay. So the total premium he's going to put into his policy to start this thing up is going to be $25,000 per year. So he has that money. It was, maybe it was going to a 401k, maybe it was going to savings originally. And he said, hey, I'm going to redirect that into this infinite banking policy first, and then use that to pay off the debts. Yeah, Rodney, absolutely. Rodney, I can. So that's what I do, by the way. So I'll give you a link here in just a moment that you can use to hop on a call with me. Yeah, there's nothing to buy here, nothing like that, guys. So on this example here, when this doctor deposits that $25,000, he does it at one time, lump sum upfront at the beginning of the year. You can do it monthly, by the way. This is just an example. He immediately, within 30 days, has $14,863 to borrow out of the policy and have it in cash in hand. So that's exactly what we do, okay? So when we borrow the $14,000 out of the policy, what do we do with it? Well, he pays off the Discover card, he pays off the Lowe's card, and he pays off part of the Nordstrom card. So what happens now? What happens to his cash flow? Well, one, the debt goes down, and his monthly payments to those debts goes down by $448. Now, this is what we're talking about, recycling and recapturing. We want to recapture that $448. We don't want to let it go out and go to, groceries or, vacation or something like that. We want to recapture it. So we're going to take that $448 and recapture it. And I'll show you how in just a moment. Okay. Now, in year two, another 25 goes in. Okay. Now, because of the compounding and because these things always compound, the cash value went up by $16,571. The payments of the $448. So this is recapturing. So you take the $448 and you put it back into the policy loan that you took out. So that replenished $5,374 of cash value inside your policy. So the total cash available now at the beginning of year 2 was $21,945. Once again, borrows it back out. What happens now? Nordstrom card, Wells Fargo card, private loan all paid off. Part of the BMW paid off as well. Okay. The total debt goes down to $378. Okay. The monthly payment now has dropped by $1,917 per month. So let's do the same thing in year 3. What's year 3 look like? Once again, same thing. 25,000 goes in, but now we're getting that compounding growth. The cash value goes up by $25,541. He's getting more out of the policy than what he put into it, by the way. The payments of $1,970 back into your policy have increased the cash value that you can borrow by 23,000 and change. So the total cash value available to borrow is now $48,545. Same thing. We do the same thing. We borrow against it. What happens? BMW gone. West Marine, probably a boat, by the way, is gone, and part of the condo is paid off. Your monthly payments have dropped by $3,677. This is, by the way, the beginning of year 3 only. So pretty powerful. Now, before we get into year 4, I want you to understand what just happened. Okay. How much did we put in? Year 1, 2, and 3, 25,000 each. We put in $75,000. But what did we take out? Loans, years 1, 2, and 3, approximately $55,000. Now, as I said, the way these insurance companies work, they pay dividends. Okay. So how much do we have inside of our policy working for us, earning us dividends? How much is it? How much is left in the policy? Anybody want to take a guess on that while I take a drink here? Yeah, Anthony, $75,000. A lot of people say $20,000 because I took money out, but that's not the way these work. The cash value is the collateral for the loans. So in reality, you still have $75,000 in your policy working for you, earning you dividends and growing every single year with guarantees. At the exact same time, you had $55,000 that you had in hand that you could use. Okay. So let's go look at year 4. Same thing happens. 25 goes in, cash value goes up by 26,000. The payments are $3,677 back to yourself equals 44,000 and change. So the total cash is $70,000 available. Same thing. You borrow out, use that to pay off a huge chunk of that condo. Now, what happens though is the monthly payment doesn't change. Okay. The reason why is because the condo and the house, those are amortized loans, which are, I won't get into that, I guess, on this call. But amortized loans, when you pay the principal down, it just shortens the number of premium or payments, but it does not change the amount of the payment itself. So the monthly payment doesn't change. So in year 5, we put in 25,000. Cash value goes up by 27,000. The payments back to ourselves are the same. It's 44,000 and change. Total cash is now $71,225. Now you pay off the entire condo and the majority of the house. Now, this is something that I wanted to show on this one. So now our payments, by the way, have gone down by $4,556. Okay. Now in year 6, we're going to do something different. In year 6, we're going to say, hey, you know what? Now that it's been 5 years down the road, my cash flow has gone up. I want to do a second policy now, because by the way, you can have multiple policies on yourself or other people. So we do the first policy, we're going to reduce the premium deposits from $25,000 down to 10. Okay. So we went from $25,000 down to 10 because we can do that because the policy is now very efficient. What do I mean by that? You put in 10,000, the cash value goes up by 13,000 and change. That's a pretty good cash on cash return. I'm going to show you some numbers on this, by the way. We got some more really cool slides that'll blow you away. We do a second policy of $25,000, okay, to get that second one going. And the cash value on that one is $14,863 available in the first 30 days. Now the payments of 4,000 and change back to ourselves equals $54,678 of increased cash value in our policy. So the total amount available is $82,000. Okay. But our house is only $76,000. So we borrow 76, we wipe out the house, where debts are gone, our monthly payments are now 0. Now in year 7, what do? Well, in year 7, you're taking the monthly payments that were going to the debts and you're paying back your policy loan to the tune of, at the end of year 7, Your policy loans are all paid back, zero debt. You have $5,777 of cash flow that is now freed up, and you can do whatever you want with it. And you have 6 figures, multiple by the way, inside your policy that you can then leverage into other assets as well. 7 years versus 19. Okay. So that is one example of how you can pay down debts very quickly, because now once you paid off the debts, what do? Now we start to build wealth with assets. Okay. Now, if you're saying, well, Brian, okay, that sounds cool, but I have no idea how that math would work. I don't know either, by the way. So we have software that we use that shows you exactly how to do what I just kind of illustrated. It's called the Debt Blaster. This is an example of what it looks like, one of the summary report, but it'll show you how this all works. Okay. Cool. So we do have software. And so also something that we do for our clients, well, so Edward, where can I find the Debt Blaster? So it's a software that we built. So we operate it. So we use it and run it. So for our clients. So if you want to, see how it works, there's a lot of parts and pieces to how it works. It's a trademark software. We don't have it out for the public just because we don't want it to be out in the public because we built it and we don't want to be liable for that. But yeah, so we run that for our clients. So if you want to, okay, you're working on Carson. Yeah, so talk to Carson about it. He can get you hooked up with it and get our concierge team connected to you, and they'll work with you on building it out. That's how it works, yeah. So we also have what's called an implementation team, which is very unique. So that if you're thinking, okay, Brian, how do I use infinite banking? How do I pay off debts? How do I buy a car? How do I do this stuff you're talking about? Because it sounds overwhelming. Well, guess what? We do it for you. So we have an implementation team that will do that for you. It'll map it out for the car. It'll map it out for debt payoff. If you're going to do an investment, I'll show you an example of that. We'll show you how to do it. And I'm going to show you some examples, some more slides of how these policies work with other vehicles, other opportunities. So yeah, so a lot of cool things, but we work with you on this kind of stuff. So now let's talk about the Millionaire. Okay, this is now we're building wealth. So question, what if I have no bad debt? What if I don't need a new car? Can I still benefit from privatized banking? Should I still become my own banker? Well, absolutely, because in my opinion, this is when the fun begins, building wealth, creating legacy. Because what if you, in the car example, what if it wasn't a car? What if it was a piece of real estate, right? That's when it gets amazing. So what are some other things you can use infinite banking for to build wealth? Okay, let me show you. Okay, active real estate investors. If you're wholesaling, flippers, buy and holds, all those things. Commercial properties. So think of like apartments, think of mobile homes, etc. Private funds, passive real estate, lending your private funds out. Business owners, by the way, a lot of business owners use this for revolving lines of credit, things like that. Okay. Stocks and options traders. I've done a lot of day trading. I probably wouldn't use my policy for that, but I do know some people that do, by the way. Startups. So we have a lot of people that are doing startups and they have capital to do the startup, but they don't want to just take that cash and dump it into the startup and then not have it anymore. So they go through the policy first, then they borrow, they use the revenue of the business to pay back the loan. But now guess what? Now they have that money always working for them. They also have that guaranteed tax-free death benefit. So in case something does happen to the business while they're owning the business, they're taken care of, right? Taken care of. It's called key employee insurance, by the way. And then equipment flipping. This is kind of a funny one. So we got a group that does equipment flipping. So you buy like a forklift, you renovate it, and then lease it back out. So there's an example right there. So I think Frank, your question is after the first year amount, can you give them more money to cover the second and third year? So you can only pay for like typically 1 year in advance. So you pay annually for the next 12 months. You can't pay for 24 months. That's typically how it works. But good question though. But you can do monthly, quarterly, annual. We'll get into that a little bit more. Now, let's go and look at an example of using the private banking for private money lending, because a lot of people understand what private lending is. You lend out money to other people, they pay you back with interest. So what's that look like with an infinite banking policy? So here are some things I want you to look at. So you're going to see here, you're going to see in the first year, $150,000 goes into this policy. So what that is a $50,000 premium deposit. So 50 is going in every year, whether it's monthly, whether it's annually, doesn't matter, but 50 goes in. This person is also doing what we call a dump-in or lump sum upfront of $100,000. That's going to grow the cash value very fast and very quickly. So this person at the end of the first year, these are all end of year numbers, has $132,000 of cash value and a $2.3 million death benefit. And they've only put in 150. Okay. So what's that look like with private lending? So let's look at year 8. Now keep it in mind, why am I looking at year 8? Because the more these are in place, the more efficient they get. So let's look at year 8. In year 8, Your bank grew by $66,722. But how much did you put in? The cash injection was only $48,594. By the way, your account grew by $18,000 and change, which is a 37% cash on cash return. So let me ask you all a question here. Would a 37% cash on cash return be good for you? Would you like to have that kind of return? Give me one in the chat box, please, if you wouldn't mind. If you think that'd be a good return on your money, would that help you build wealth differently? Lee says one. There you go. Jerry says one. Anybody else want to have that kind of cash on cash return? I know Frank does. I know Anthony does too. Anthony's probably getting more than that. So how does this look though now with private lending included? So if you've ever done hard money lending real estate, they typically lend out at about 12%. Let's use 12% as an example. Okay, so let's look at the deal where you lend out 12%. So here's the deal. So when you do that, when you take that $66,000 right there, or even the $531,000, and you lend it out at 12%, what's it look like? 12% private money deal, 37% from your private banking. You're paying your loan back to your banking policy at 5% back to the insurance company. That's a 44% cash on cash return on your money just by private lending. But here's the thing. If you didn't do infinite banking, what would it look like? Because we didn't do anything different other than where your money goes first. So the question is, would you rather make 12% or 44%? When you private lend, you'll make 12%. With infinite banking, yes, keeping in mind it does take some time to get to these kinds of numbers, it's 44%. But even in year one, it'll be more than 12. It's going to be quite a bit more. But this is how infinite banking can work. This is how you build wealth by doing a couple of things differently, where your money goes first. All of a sudden, you're building your wealth 3 times as fast. That's amazing right there. Okay.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you've felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
The power of compound, uninterrupted, by the way, compound interest is amazing. Yeah, it's amazing. So we've all heard of compound interest. When we think of, a lot of people, when I say, hey, what do you think of when you hear the term compound interest? They think of, oh, I think of my 401k. I think of the markets, I think of that. In reality, that is compound interest, but it is interrupted compound interest, because if you have a negative year, you don't have any interest. You have negative interest. So it's interrupted. With infinite banking, the dividends you're getting are uninterrupted, meaning that if you borrow money from your cash value, you borrow money from your policy, you don't interrupt the compound. You still have the compound interest earning no matter what, even though you borrowed the money. You now have your money working for you in infinite banking and in something else. So what does that do for your money and your wealth? Well, look at this. Look at year 10 as an example. In this example, somebody put in $50,000, and they're putting in, almost $6,000 per year. So that's how this policy is structured. Now, in year 10, they put in that money. They have a 54% cash on cash return, and they have 154% access to capital, meaning they have more available than what they've put into the entire thing. In fact, in year 5, it's 26% cash on cash and 126% access to capital. But the power of uninterrupted compound interest is, look at this. In year 20, it's 191% cash on cash and a 291% access to capital. It just keeps getting better and better. Year 30, 386% and a 486% access to capital. So that is the power of uninterrupted compound interest. Okay. Now, really quick, how do you eat an elephant? It's one bite at a time. How did the man at the top of the mountain get there? He didn't fall there. What did he do? He took that first step, right? So when you look at this, you might say, okay, man, the top of the mountain is great. How do I get there? Hey, how do I eat this elephant called, wealth, right? It's taking that first step, by the way. It's one step at a time. That's just, that's just my belief there. But you've got to take that first step, because eventually you'll be at the top of the mountain. You'll be at that place that you want to be, but you got to take that first step. And I'll say this again, it's a marathon, not a sprint. Yes, there's a lot of short-term benefits, but I always want to say it is definitely a marathon. Now, the machine, this works for debt. It works for expenses, vacations, homes, taxes, by the way. What else can it work for? So let's look at if we continue to pay back those homes as promised. So remember the example I gave of the doctor, and he was paying the condo and the house back. So let's look at those two debts. If you pay back the condo, pay back the house traditionally, okay, not through infinite banking, but paid them back traditionally at 251 months, he would pay back on the condo $220,000, on the house 224 months, pay back $273,000. He would pay $493,000 out of pocket, by the way, and own the house on the condo outright. Now, let's look at it with us being the bank. Let's say we are the bank, okay? We're going to say, let's say it's 4% we're going to earn. If you do that, you're going to earn $344,000 on the condo and $405,000 on the house. Now, this is that money working for you compounded inside the policy. What's that going to turn into? Now, this is to illustrate how debt can really erode wealth. You're going to earn $749,000. So that's if you use infinite banking as I illustrated. So the flip side is over time, if you'd paid that loan back, you would have paid $450,000. Okay. If you had done infinite banking and have that money now working for you inside the policy instead of inside the bank's hands, it's going to turn into $400 or $749,000. That's a swing of over 7 figures during the same time frame, by the way. So if you do things traditionally, this example, once again, you'll have, I don't want to say lost, but you'll have paid $400 and some thousand versus doing infinite banking, just changing where your money goes first, you'll have made $749,000. That is the power of compound interest over time. It's like it's a big number, by the way. It's a little big swing. So yes, that's going to help you build wealth. And once again, if you're trying to say, well, how do I do that? This is another one of our softwares called the Gain Projector. This one helps you understand how like infinite banking will work with an opportunity like real estate or an investment. We plug in the numbers, plug in the cash flow, and show you how to funnel the money through it and how it'll help you build wealth faster. So you'll see all the numbers and stuff. It's really, really cool for investors. So if you're an investor, you want to see how this works, definitely check this out. Just reach out to me and I'll get hooked up with our team that can show you that. All right, so guys, I do have more slides that can give some more illustrations on some of the numbers. And then, as I said, keep asking questions. Please ask as many questions as you can. That's going to help everybody else that's watching as well. So now that you know this, I believe everybody should do this because one of the biggest things in life that we want to control, as we all talked about, is wealth, is our money. And I also want my children, my grandchildren to understand a better way of dealing with money than I was taught. I truly do. Because we all need to break the bonds of financial slavery because I believe that we are slaves to the financial institutions and what we are taught. So you've got to break that. And so if you're understanding this and it makes sense to you, please share this information, share the videos, share the knowledge because, man, I mean, I've seen this transform so many people's lives. It's amazing. It's just so cool to see how it can change their lives. And so definitely recommend sharing this. Now, make that money work for you. That's what this does. This makes your money work for you. I was the guy at the bottom. And by the way, there's nothing wrong trading time for money. We all do that. But when you get your money working for you, it really flips things around quite a bit. Yeah. Now, there's a lot of other benefits that I want to talk about with infinite banking. Whoops. And some of the other aspects of it that I want to make sure that you are clear on. So the first one, we didn't really talk about the death benefit. I'm going to talk about that here in just a moment. Loans, the loans never have to be repaid. We're going to talk about how the loans work, okay? The internal values inside your infinite banking policy, they grow tax-free. I love tax-free, right? Tax-free is awesome. Policies are exempt from judgments and liens in most states, meaning this is a protected asset. By the way, it's not public knowledge like a 401k or your bank account is. It is private, meaning that people don't know about it. It's hidden. It does not show up on your credit report. You can also create tax-free income. You can do that. You can create tax-free income with this concept. It's pretty cool when you see that. Now, let's talk about the death benefit. So you'll see that right here, over here. Now, in this example, this is a female, age 42, putting in $20,000 per year for the first 5 years, and then she's going to drop it down to $3,257 in year 6 and beyond, and eventually down to zero. Now, what you'll notice at the very beginning of this policy, $20,000 goes in, whether it's monthly or quarterly, doesn't matter. The death benefit is $325,000. That's quite a bit more than what she put in. But here's the thing, in year 2, 20 goes in, the death benefit went up. It's always going to be going up. In year 3, 20 goes in, cash value goes up by over $20,000. By the way, death benefit continues to increase. It's an always increasing amount. Even when she drops the premium down to $3,000, guess what? Cash value goes up by twice that amount, and the death benefit keeps going up. And that, by the way, is guaranteed to be passed on at some point down the road, hopefully a long ways down the road, tax-free. That is guaranteed generational wealth. Now you know why the wealthy people do this, because they know they can put in, over the course of 5 years, that is $100,000. And yet, if something happens to that person in year 5, it'll be passed on guaranteed tax-free almost 5 times that amount. Pretty powerful. Okay. Policy loans. Let's talk about policy loans really quick. So policy loans, they are guaranteed. You do not have to ask permission. You log in, request it, and you shall receive the funds 1, 2, maybe 3 days. Okay. Pretty fast. No credit check, no approval, ask and you shall receive. The loans are private. They do not show up on your credit report, which is very interesting considering how banks do it very differently. They show up on your credit report. By the way, the credit bureaus are private, for-profit organizations, not government organizations either. So just keep that in mind. With the policy loans, there is no minimum or maximum payments because you are the one in control. If you don't want to make a payment, that's fine. If you want to make, one lump sum payment, up to you. You are the one in control. If you don't make a payment, nobody is going to call you up and say, hey, where's the money? Does not work that way. Okay. Miss a payment, as I said, nothing happens. All right. How can I fund my banking policy? How can I put money towards this? What does that look like? Okay. So as I said before, you can do monthly, you can do quarterly, you can do annually. It's up to you how you fund this. The minimum we recommend is going to be 10 times your age per month. 40 years old, 400. 50 years old, 500 per month. Pretty simple. The maximum depends on the individual, depends on your gross income, your liquidity, your net worth, your all that kind of stuff. But generally speaking, it's going to be anywhere from 15 to 30% of your gross income. Not adjusted, it's gross revenue and income. Okay. On top of premium deposits, you can fund the policy up front with a large dump in. Let's say you're doing, like as an example, we showed someone doing, they put in $50,000 and a $100,000 lump sum dump in. It could be $5,000, annual premium and a $10,000 lump sum deposit. That just gets the cash value growing very fast, very quickly, because when you do these kind of things, anywhere from 50, not typically, but up to 90% or more goes to cash value within the first 30 days. And you're buying that thing right away. So if you ever go talk to another life insurance person, by the way, because keep it in mind that I'm an entrepreneur, I own multiple businesses, but if you go talk to a traditional life insurance person and you say, can you set me up with a cash value life insurance policy? Oftentimes they'll say, yes, I can, but you won't have any cash value for the first 2 to 3 years. If they say that, run the other direction. They don't know how to do infinite banking because it should be within the first 30 days, by the way. Now, someone says, well, why would I put in money, up front if I put in, like, let's say $10,000, but I only can access 9,000? Why would I do that? Because as I showed you, down the road, you're going to have access to 300%, 200%, 400% of what you put in over time. It's going to keep growing no matter what you do. So the question is this: would you put in $1 into an ATM in order to pull out $3? Absolutely. Of course, we all would do that, right? And so that is what this can get you to a point of what you're doing. So what do I mean by that? Okay. So let's kind of look at this example. This is an example of someone putting in $10,000 per year. Once again, don't get hung up on the numbers. They're based upon you. It's all customized. And they're going to put in a $50,000 amount of money upfront as well. So they're going to put in $60,000. But here's the thing. At the end of that year, they have access to $55,000. That's over 90%, I believe, of that amount. Okay. Now, let's look at it in year 2. In year 2, they put in $10,000. At the end of that year, they have access to $10,600. They're already cash on cash positive. I don't know other vehicles that do that, right? Where you can borrow it back out without losing that growth. In year 11, we've now dropped the premiums down. This person puts in $3,000 and has $10,590 of growth. More than 3 times what they put into it. This is a very efficient vehicle. In fact, this person has put in $150,000 and has access to $185,000, and that's going to get better and better and better every single year. So, quick example of how these can work. Now, this is a quote by Warren Buffett. I kind of like this quote, But it says that if poor people would just do what the rich people do, they wouldn't be poor anymore. But I like to change that quote. If poor people had the knowledge of the rich people, they wouldn't be poor anymore. And this is one of the concepts that the wealthy use to maintain, retain, and grow their wealth. So now you know how it works. So once again, guys, you can go to brian.beyourOwnbanker.com to grab a time with me personally. And I have a couple more slides, but to grab a time personally with me, that's my link right there. And if you guys want to, reach out to me, if you guys want to get a link to those free PDFs that I mentioned, those books, send me an email and I'll send you the link as well. So there's my email information right there. Cool. Yeah. Great, Anthony. Look forward to talking to you, man. It's awesome. Yeah, so that's a link right there. So let's go through the next slides really quickly. So one question I do get quite a bit is, well, Brian, why should I work with you, or why should I work with you in the money multiplier? Okay, well, I've been teaching infinite banking for over 7 years, taught hundreds and hundreds, thousands of people now this concept. We at the Money Multiplier, we have an entire team that works with you to set up infinite banking. So it's not just me and my assistant or me and my partner. We have an entire team, and so we're always providing ongoing support, ongoing services. Like this presentation, we do live every single week. It's either me, it might be somebody else that does it sometimes, but we do ongoing things. We actually have a thing on Wednesdays called Ask Me Anything, where you can hop on and ask any question you want about, well, mainly infinite banking, but anything you want. And I'm on there with a bunch of our other team members. We are one of the largest producers of infinite banking in the US. And so it's a couple of the big companies that we work with that do infinite banking. We are the largest independent broker in the US. So that's because we have a lot of repeat clients and we have a ton of referrals because of how we do infinite banking and how we treat our clients, to be honest. I currently have over 100 clients, I believe, right now in underwriting. So yeah, quite a few. Noreen, yes, you can work. Can anyone work on your team? Oh, I thought you said work with our team. No. So there are ways that you can work with us as being on our team. There's a process to that, but if you want to understand more about it, just schedule a call with me or send me an email and I can walk you through what that looks like. So we do ongoing support and services. So after you have a policy in place, one of the things that I hear a lot from other people that really just, I don't want to say pisses me off, but it sucks, is that someone gets a policy set up, but they don't know how to use it. It's like, think of it this way. If someone says, hey, here's the keys to this Ferrari, go drive it, but you've never seen a Ferrari or never seen a car before, how are you going to drive it, right? And I see that happen all the time. Someone says, oh my gosh, I want to have a infinite banking policy. They have their brother-in-law or somebody else set it up for them, probably not the correct way, but then all of a sudden, like 3 years later, they're saying, how was I supposed to have used this? I don't remember this. I've had that happen so many times. So you have access to me. You have access to my team. You have access to your implementation specialist on an ongoing basis. There's no cost, no fees. So you have access like that ongoing. So keep that in mind. So that if you want, hey, how do I drive the car? We will show you. No cost to you. We don't charge you anything. There's no fees, nothing to work with us. Keep that in mind. Okay. All right. Wade, is this available if you live in the UK? The short answer is no. It's only available to US and Canadian citizens. Can you do it in the US if you live in the UK? Yes, you sometimes can. Now, if you have a US, social security number, you potentially can. If you have family here and you can do it on them, you can do it that way. And then if you have if you have a business here, you potentially can do it. So if that fits your criteria, then let me know and we can talk about it. But if you're not a US citizen and you don't have any business here, then it is very challenging. And we wish they would expand outside the US, but they just don't do that because every country has their own insurance regulations. All right. Now the next question I'll cover really quickly, there we go, is IUL or VUL, are those infinite banking? Now this is a question we get quite a bit, and that's indexed universal life and variable universal life. Are those infinite banking? The short answer is this. It's no, they are not. They are not infinite banking. IULs and term insurance, by the way, pay some of the highest commissions out there, okay? We take a 70% cut in commissions to do infinite banking. And I'll actually show you the math. If you want to see it, I'll show you the math of how this looks when for us for commissions versus traditional. But yeah, we take a pretty big cut. That's why a lot of other financial advisors and agents will not touch infinite banking because they don't want to take the big cut. So the way that I say this is that we give so that you get. We give commission and you get the benefit. Okay. Our team only does infinite banking. So we just do infinite banking. We don't do IULs or VULs. We don't do home insurance or car insurance or health insurance. We just do this. Additionally, I'll show you this right here. This is what is called the infinite banking. Probably can't see this on the camera, but maybe you can. It's called the Infinite Banking Practitioners Program. This is the Nelson Nash Institute that certifies infinite banking practitioners like me. And this, by the way, this is the people that popularized and made infinite banking what it is today. If you touch an IUL, if you touch a VUL, they will kick you out of their entire program and community. You cannot be a part of it if you touch it. So yeah, so keep that in mind. Frank, great question there, by the way. What if you move out of country? You're fine. Yeah, you're fine if you move out of country. And we have people actually that are not living in the US that have infinite banking, by the way. Usually it's not common, but yeah, leave, no problem, man. No problem. Now, a couple other really quick things, and then we'll wrap it up here. So there's two things that'll happen in life, right? We live, right? Now, if we live, are we better off or not with or without infinite banking? Okay, so think about that. Are we better with this when we're alive or not? Well, you just saw the living benefits. Okay. We also know that we're going to die. Like we're all going to die. Are we better off with this in our life or not? So we look at the generational wealth aspect. That's the face value. Yes, of course, we're better off with it. That's why the wealthy do this on every member of their families, because they know that $1 will turn into $10 guaranteed tax-free. Okay. So just keep this in mind that these two things do happen, right? We live and we die. Now, let me tell you kind of a quick story. Now, when I first learned about infinite banking, I was the guy on the left. I was the guy in the little thing saying, you know what? I don't need this, right? That's group one. I call that group one. And group one is the people that learn about, something like this or an opportunity or a strategy. And they're saying, you know what? I don't want to learn anything new. I'm going to bury my head in the sand. I'm not saying that, to be derogatory, but I don't want to learn anything new. I don't need anything different. And when you see wealth being transferred, which by the way happens all the time, but it accelerates during a recession or when markets go down, wealth is transferred fast. Who do you think it's transferred from? Typically group one, the people that stick with what they've been doing. They don't want to learn anything new. They don't want to educate themselves. They don't want to gain more knowledge, right? They're usually stuck, but they don't feel stuck. They just don't want to learn it. That's a mindset thing, by the way, a huge mindset thing. And I was that way for a long time. But then group two is the people that I see that when you learn something new, you learn about a new opportunity, you say, hey, I want to know what's going on behind the scenes. I want to know how this can benefit me, how it can benefit my family, benefit those around me. And they're the people that always want to have, that new knowledge. They want to increase their knowledge and they want to, master cash flow in their lives and build wealth and live just a better life. And so I always ask people, I said, which group sounds better? Which group do you want to be in, group one or group two? If you guys want to be in group two, put a 2 in the chat box. If you want to be in group one, put a 1 in the chat box. Probably won't put a 1 in the chat box, but I mean, which group sounds better? Group one, which is, by the way, go it alone, beat your head against the wall. That's what I did for so long, by the way. I have so many stories that I could share about this. Because actually Frank said, I knew about this 3 years ago, right? But probably the way that you're hearing it now might be a bit different. I learned about this 10 years ago and I had no idea what it was. I was group one, by the way. And I see nobody put a 2 in the chat box. So nobody wants to be in group two. Oh, there's one in the private. There's a private one. But yeah, group two. Yeah, Dana says, yeah. And Helmut says, yeah, group two makes sense, right? Because that's really where when you surround yourself with group two people, it's crazy. If you're surrounded by group one people, that's the challenge. If you're in group one and you're around group one people, you've got to surround yourself with group two. And so just by being a part of this presentation, by the way, by being a part of the Money Multiplier community, being on some of our large, our events that we do, that's how you get around that different way of thinking, right? So here's the thing, guys, there's no obligation to this. If you want to talk to me about it, just grab my link, grab a time, and let's chat about it. Because here's the thing, I'm not gonna, try to pitch you on anything. I don't sell anything, by the way. Yes, I'm an agent, but I do not sell anything. I'll help you understand how this works. And if it's a fit, I'll let you know. If it's not, I will tell you it is not a fit. I told it to somebody here today. And this is a client that has gone through the underwriting process and has an approval in place. And I told them it's not a fit right now. I would not recommend you do this. And it was a large policy. And I said, don't do it. Please don't do it. I don't recommend this. So we're very, very open about that. And if you have any questions about how we make money, I'm very open about that as well. Yeah, Frank said always on Tuesdays and Wednesdays. Yeah, Wednesday, Ask Me Anything, Wednesday Wealth Webinar, Tuesday Take Back Control. We have the Monday WTF that Chris and Steven do. Yeah, we do a lot of stuff. But yeah, Noreen says, yeah, already doing this. Yeah, it's amazing. So yeah, there's Noreen, someone who's already doing infinite banking, saying, obviously it's pretty cool. So let me go ahead and put this stuff in the chat box again, where to go. And then Any last minute questions anybody has, go ahead and put those in the chat box, put it in the Q&A box. There's my personal call link right there in the link or in the chat box, brian.beyourownbanker.com, or you can reach out to me at brian@chrisnaugle.com. That is my personal email address. And I'll leave this last slide up here, this quote. I love this quote. It's the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. Very powerful quote. I love that one. Well, Frank, if nothing happens if you move out of country, nothing happens. Yeah. So we have people that are not in the U.S. that have policies. Yeah, and I even have this is not something I promote to do, but we have people that are U.S. citizens living outside the country, and they are doing this. Yeah, they were able to do it. I even have somebody that they're based. I can't remember where they're based, in the UK or something, and then they have a family here in the U.S. and so they have money. And they want to they don't want it to just get dispersed when they pass. So they're flowing it into policies on family members in the US. So that's another way you can do it. If you're in the US doing business, then you can do it as well. But yeah, Dana. Yeah, absolutely. Appreciate that as well. Likewise. Appreciate the questions, appreciate you guys' interaction, that kind of stuff. So yeah, if you guys schedule a call with me, I look forward to talking to you on the phone. That being said, if we don't have any other questions, we'll go ahead and call it a day here. You guys can get back to your day. We're gonna have actually a big team meeting here in a little bit. I'm looking forward to that actually. But yeah, gonna be a busy week. Anthony, look forward to talking to you soon as well. And Maria, appreciate that as well. Appreciate that. Thank you so much. All right, everybody. Thanks once again, and hopefully I'll talk to you guys on personally, one-on-one. But with that, have a great rest of your week. Yeah, thanks, Victor. Appreciate that. Thanks, Melinda, Helmuth. Yep, appreciate that as well. All right, take care, guys.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.